Imagine sitting on over $300 billion in cash, enough to buy 5% of the entire US Treasury market. Now imagine refusing to spend a penny of it because the right opportunity hasn't shown up yet. That's exactly what Warren Buffett is doing at Berkshire Hathaway, but why? Is he playing defense in an overvalued market, or setting up the perfect handoff for his successor, Greg Abel? Let's find out. At a recent shareholder meeting, Advate Prasad from New York asked Buffett a question that every investor wanted answered. Berkshire's holding over $300 billion in cash and short-term investments, 27% of total assets, compared to just 13% on average over the last 25 years. Beyond insurance liquidity, is this a defensive move against market risks, or are you positioning Berkshire for a smooth leadership transition? And to add a little spice, another shareholder, Mike Conway, chimed in, "Warren, are you expecting some fat pitches to come your way soon?" Buffett laughed and said, "Well, I wouldn't do anything so noble as to hold back on investing just to make Greg look good later on." Crowd laughs. "If Greg gets an edge after I'm gone, I'll probably resent it." Then he got serious. "We came close to spending $10 billion not long ago, but we'd happily spend $100 billion tomorrow, if the right deal came along. The problem is opportunities don't show up in an orderly way," he continued. "I've been doing this for 80 years. That's about 16,000 trading days. It'd be nice if every day gave me 4 great investment ideas, but it doesn't work that way." Then, in classic Buffett fashion, he turned the conversation into a lesson. "We're not running a slot machine. We're running an opportunistic business. Things don't come evenly. Charlie Munger always said I did too many deals, that we'd do better focusing on just 5 great ones in a lifetime." Buffett paused and smiled. "We'd rather have only $50 billion in treasuries if it meant we found great investments. But that's not reality." Then came the golden line, the essence of Buffett's philosophy. "We've made a lot of money by not feeling the need to be fully invested all the time." Buffett explained that most investors feel pressured to do something, but patience is what separates great investors from everyone else. "If you told me I had to invest $50 billion a year until we ran out of cash, that would be the dumbest strategy ever. Great opportunities appear rarely and unpredictably, but when they come, you'd better have the cash ready." Then he leaned back and said something that made the audience chuckle and think. "It could happen next week or 5 years from now, but not 50. Opportunities are like death. The longer you wait, the higher the odds." He grinned. "When you're 10, your odds of dying tomorrow are pretty low. At 95, well, let's just say they go up, especially for men. Women hold all the longevity records. I once told Charlie he should get a sex change to test it, but he didn't. Still, he did pretty well for a man." Buffett's message is clear. Cash isn't a burden, it's optionality. It's the power to act when everyone else is panicking. While others chase daily moves in the market, Buffett waits. And when that rare fat pitch comes his way, he swings big. Because in investing, patience pays more than prediction.